Hi guys, wanted to go over a housing article and a couple charts that I came across in preparation for tomorrow's whiteboard video. A lot of you have been talking to me about what's going on with the housing market for 2021. Do I see it crashing? Do I see it going up? What's going to happen in nominal terms or real terms? And it all starts with the data. So let's dive into this article from Business Insider. The U.S. is in the middle of a housing crisis, but that doesn't mean we're going to end up in a 2008 style housing crash. Okay, let's see the argument. And by the way, Sebastian just found this highlighter app for me. So now I can highlight the parts of the articles that I want to talk about. We're making huge improvements every day. So the first chart here is foreclosure starts, and they've plummeted to all-time lows. Not surprising. We're sending out stimulus checks and unemployment checks, and we're putting a moratorium on mortgage payments and possibly foreclosures. I don't know if the banks right now are even allowed to foreclose, but obviously we have the moratoriums, we have the stimulus checks, so it's not surprising that they're at all-time lows. This just goes to show you how the Fed and the government can mask what's really going on in the underlying economy. You know, it's like a tsunami where if you see it at deep water, you look at the surface and it seems calm and crystal clear and nothing's going on. But underneath the surface, that tsunami is gaining more and more momentum. So as it gets closer to the shore, it starts coming up and up and up, and then boom, complete disaster and catastrophe. And it's kind of like how I see the economy right now and everything that the Fed is doing to mask over, and the government, this tsunami of flawed fundamentals, let's say. So first part I highlighted, the large number of Americans behind on their mortgages are still, and the still rough labor market. Rough, that's an understatement. We're going to check that out in just a moment. Creates a worry that we're about to see a tsunami of foreclosures that will flood the housing market with supply. And this next chart goes over the mortgage delinquencies, which the author says is a reason for optimism because they're going down. And this is the next section I highlighted. First, the share of delinquent mortgages, that is the mortgages that are where the owner has missed at least one payment, has fallen 7.8% in May to 6.4% in October. So he sees this as something that we should celebrate, or reason for optimism, to use his words. And I don't know that I would go that far. The first thing that came to my mind when I saw this chart, well, yeah, they're going down because everyone's getting a stimulus check. And again, we go back to the forbearance programs. And then he mentions that right here as kind of a side note. Part of the reason for this is the fact that forbearance programs introduced by the CARES Act. Part of the reason? I don't know. I would say maybe 100% of the reason. And let me show you why I'm saying this. Let's go to initial jobs claims. The author talked about the fragile employment market, or you use some adjective that I don't think really describes it well, probably a little too timid. But let me move my face here so you can see. So this is the initial claims on the Fed's website. See, this, as the most recent take here, was 787,000. So unemployment claims or jobless claims. And obviously, it's come down significantly since March, where we had 6-7 million. But let's look at this and keep it in context, meaning that it went down here. Now it's starting to trend up. Let me move this chart. So now it's gradually starting to trend up. And Jeff Snyder and Emil Kalinowski have talked about this on their Making Sense podcast. But the main thing here, even if it's kind of flattening out, the fact that it's even flattening out is disturbing, is very alarming. Why is that? Let's go back to the GFC, which was the biggest financial crisis since the global depression. And we look at the numbers here, and the maximum they got up to was 651,000 initial jobless claims. And then we compare that to where we've plateaued now at, call it 800. So where we've plateaued and where we're just continuing straight across the, call it a trend line, is 200,000 worse than the peak of how bad it got during the GFC. So I think this author and a lot of people are kind of glossing over this unemployment problem we have because they see maybe the unemployment rate itself going down, and they're not thinking through the labor force participation. But this is a huge problem, not only for the economy at large, but more specifically for housing. And I talked to Ken McElroy about this, who believes that we're going to see a big drop in prices at the end of 2021, a result, and he sees that because people are going to be losing the forbearance. Once they went on, like for 6 months, they could extend it another 6 months. So he sees those coming to an end. And then he sees the unemployment rate being so high, or the real unemployment rate, or how many people actually need money, let's say, being so significant that people are going to have to sell their homes because they need to extract that equity just to live and just to pay the bills. So you're going to see a flood of supply from that standpoint. Makes a lot of sense when you look at this chart of initial jobless claims here on the Fed and compare that to what it was back in the GFC 2008, 2009. So let's go back to our article here. I just wanted to point that out to give it some context. My face always moves around here. I don't know why it does that. Okay, so let's keep going down. And the article points, or the author points out that the number of homeowners receiving forbearance due to COVID has kept falling. Okay, I mean, I guess that's good in a way, but it's still at 3 million homeowners are on forbearance. I don't know if I don't know that that paints a rosy picture. And then he goes on to state that low interest rates mean a monthly payment for median existing home with a 20% down payment only requires 45 hours of work per month to cover the average person. So whenever you look at the National Association of Realtors, you'll see that they're very consistent and that they go out and take any data they can find, and their only objective is to spin it to make the real estate market look fantastic. I mean, they are masters at doing this. So they're basically taking interest rates and saying, okay, with the current interest rates, the monthly payments relative to incomes are extremely low. And yeah, I mean, that's true. I wouldn't say that that makes housing cheap, because when you sell, your equity is based on the price of the home. It's not based on the price of the mortgage payment, the monthly payment. I mean, to a certain degree it is, because it makes it more affordable. But when rubber meets the road, it's all about the overall price of the home, not necessarily the mortgage payment, when you look at just your equity. But one thing the author doesn't point out, I think a lot of people miss, is if interest rates go back up. And the argument would be, yeah, George, but it's not going to affect this person because they most likely have a fixed rate mortgage. And that's true, but it's going to affect anyone that they would want to sell to. That affects the buyers. So we're just thinking about the seller, or the initial buyers, and we're not thinking about the point in the future when they might want to sell and what that does to the overall housing market and the overall prices. So if interest rates go up to, let's say, 5%, say mortgage rates, then that is going to reduce the purchasing power of future buyers, is what I'm trying to say. And that's going to definitely be a headwind to prices. And you may say, well, George, the Fed's going to peg the yield curve. Okay, well, that's fine, but mortgage rates aren't treasury rates. What I mean by that is the treasury rate, or the rates on treasuries, well, the government is paying for debt. We all know that. But what the mortgage rates usually are a specific base rate plus a risk premium. And that risk premium is calculated using future inflation expectations. So as an example, even if the Fed pegs the 10-year, let's say, and that's the base rate for mortgages at 0%, you could still see mortgages at 10% if future inflation expectations are 20% or 15% or whatever. You see what I'm saying? Because that mortgage rate is really a market-driven rate that includes future inflation expectations and a lot of other risk factors. And that's why when you listen to Lacey Hunt, he's always talking about the risk premium and the Fisher equation and whatnot, taking us down a rabbit hole. But so my point is, yeah, the Fed can peg the yield curve, but that doesn't necessarily mean that that the same process would peg mortgage rates. Now, there is an argument for the Fed coming in and just buying the paper immediately. So before the ink is dry on that mortgage, they're going to go ahead and buy it from whoever processed the loan. And that would keep mortgage rates down. But that's a separate discussion. And then you have to ask yourself, if they're doing that, okay, what is that doing to M2 money supply? What's that doing to broad money? What's that doing to the amount of currency units that are in the real economy chasing goods and services? And at a certain point, that goes up. And then you say, well, that might move housing prices up. Yeah, it might, but the housing prices might come down in real terms. We can't just think of housing prices in nominal terms. If inflation is going up by, let's say, 10%, and the value of your home or the price of your home is going up by 5%, you're losing purchasing power. The price of the home adjusted for inflation is actually coming down. So got to think that through. Moving on. CoreLogic estimates the average mortgage borrower gained $17,000 in equity in the third quarter alone of this year. Why I highlighted this is because I want to make sure that everyone that watches my videos understands how our economy is built on asset prices, debt, and confidence. I say it all the time. And I try to be redundant because new people are always watching the videos. And I think it's extremely important that we just drive it home. And that's kind of our starting point for the framework and how we look at the U.S. economy. And this illustrates it. So think about all the spending and the consumption and all the businesses that are still in business, the ones that didn't get shut down, because people basically got a $17,000 windfall. Basically, they won the lottery for $17,000. And of course, that equates to purchasing power. So, and that's going to trickle down, for lack of a better word, into the economy. But just think about what would happen if we went an entire 10-year period and no one's purchasing power increased because of the assets they own. The only way that their purchasing power would increase is if they were more productive and if they produced more stuff, if they created more goods and services. Just think if our purchasing power as a society, Americans as a whole, if our purchasing power was limited by the amount of stuff we produce. So consumption actually equaled production. Think about what the standard of living would be. How much would it decrease? Personally, I think it would decrease substantially, but that's something that I would encourage you thinking through and figuring out on your own. But this $17,000 in additional equity that's basically they can extract through a line of credit or a cash out refi or something like that, and how many knock-on effects that has to propping up the economy artificially is something that I just don't think can be overstated. And this is kind of again, one of these charts that makes everything look rosy. The lowest leverage, yeah, as far as what they're doing is it's not the lowest amount of debt. The debt's at all-time highs, but when you look at the amount of debt relative to the home price, then it looks low, but okay, that's because home prices are astronomically high. That just goes to prove my point, and that it's in a bubble. I mean, you look at the home prices, and we have to ask what's cheap and what's expensive. And if we're buying what's cheap and if we're selling what's expensive, there is no argument whatsoever for home prices themselves being cheap right now. And I think there's a lot of data that would suggest that they're extremely expensive. Number one data point being that in most markets, prices are higher than in 2006, adjusted for inflation. So would anyone you know argue that we weren't in a housing bubble in 2006? Would anyone? No. So if prices are higher now, and prices, and let me be very, very clear. Not only are prices higher adjusted for inflation, prices are just as high, if not higher, when you consider real income. Income, the thing that you actually need to make the mortgage payment. See, those prices in a lot of markets are at all-time highs as well, higher than 2006. So how can you argue we're not in a bubble? Now, granted, there's some arguments that the prices could go higher in nominal terms, and I get it. I totally get it. But that doesn't mean that we're not in a housing bubble. I mean, come on, let's be honest. Any fifth grader that would look at a chart of home prices going back to 1900 and look at where we were in 2006 and where we were or where we are now would say, yeah, bubble. And see, here's this other thing that I highlighted. The good news is that home prices have been surging recently. Good news for who? Look at 52% of adults 18 to 29 are living at home with their parents. And a big reason is because they can't afford a house. Why? Because prices are sky high. So it's good news for who? Sure, it's good news for the people who hold assets, but it's horrible news for people who are trying to buy a house. Goes right back to what Chris Cole always says, and that I reiterate as much as I can because it's so important. It's such an important concept to understand. You cannot destroy volatility. You can only transfer it. So if we're trying to destroy volatility in home prices, meaning we're trying to artificially just make them go up and up and up and up and up, just gradually with time because of those artificially low interest rates, this isn't doing anyone any good on net balance, right? It's not doing society any good. Yes, it is benefiting a few, but what you're doing is you're creating more anxiety, more stress, and therefore more social unrest with the other 50% of those people who don't own homes. So it's not like this is good news for society. This is bad news for society when you look at it in aggregate total. That's what I'm trying to say. When you're not just looking at the people who own homes. And here's another, yeah. So every time I look at one of these highlights, it just it re-triggers in my mind what I was thinking about, and this stuff gets me fired up. Look at it. The number of listed homes is at its lowest level since 1999. There's a big imbalance right now. Okay, and this is their argument for why prices are just going to continue to go to the moon. And yeah, I get it. But last time I checked, the cure for high prices was high prices. Why is that? Because when prices get to a certain level, it makes it profitable for home builders to come in and build more supply, which brings the home prices back down. That's why if you look at a chart going back to 1900, you see that those prices always keep up with inflation and therefore pretty much stay consistent with real wages. Why? Because when they go up, the builders come in and build more supply. Why hasn't that happened now? Or why hasn't it happened recently? Mostly because of regulations and because the cost of construction materials have gone up so significantly. But at some point in time, if prices go too high, even with all the insane regulations and lumber quadrupling in price or whatever it's done, you get to a point where they're going to be able to make profit. You bring more supply to the market. So when I look at the lowest levels of supply, I mean, short term, yeah, I totally get it. Definitely a tailwind. But longer term, to me, that's kind of a headwind. And what gets me fired up is when they just spin it. Of course, look, National Association of Realtors, shocker. And then the article concludes with this, which really got me fired up. Atlanta recently banned the practice of harassing lower income homeowners into selling their properties, often at a discount to fair value. To investors, oh, of course, it's always the greedy speculators, and it's always those devious investors. There are similar protections in place in Chicago, and New York activists are working on their own efforts. Okay, so let's break down I don't want to say liberal because I don't want to cast a shadow on everyone that claims to be a liberal, but let's just say this is the progressive spin that we hear. We'll call it the AOC spin. How about we do that? I think that's fair. So as a real estate guy, I think I've got quite a bit of authority here because I've bought so many homes from wholesalers, and I've bought homes directly from sellers who are motivated to sell because they've got a big problem. They've got something that is creating a massive problem in their life where they need liquidity. They need to sell, and they can't wait 90 days. You got to think, even if you sell your home today, it's still going to take at least 30 days, usually, to close the deal because of inspections and the paperwork and the title company and everything that's involved. So if you need to close the deal by Friday, well, then you're going to most likely, you're going to have to sell it to an investor. And there's plenty of opportunities to do that. You see those bandit signs everywhere, every street corner you go to. In front of a Walmart, Home Depot, you see, we buy your home for cash. We call those bandit signs because in most places they're illegal. but the wholesalers just basically put them up on Friday nights, and then they usually take them down on Sundays because the police really aren't checking for that stuff on the weekends. Is why you typically see them on Saturdays and Sundays. Just some insider intel for you. But let's look at what's happening here. It's not like these investors are going to these homeowners and harassing them. That is utter nonsense. And it's not like they're putting a gun to their head and they're saying, hey, give us your house for 50 cents on the dollar or else, you're going to have problems. No, listen, most of the time, these people are seeking out the investors because they need the liquidity. The investors are providing a service to these individuals. And you say, well, George, that doesn't make sense. No one would ever sell their home for under fair value, or at least, and listen, these investors aren't getting them for 50 cents on the dollar. Usually you're getting them with a bit of a spread that makes it worth your while. And for the additional risk, what's the additional risk? You can't do an inspection, for heaven's sakes. You can't go in there. And so you see, well, can't you just look around? Listen, you don't understand how real estate works. You could go in there and they could have a finished basement. So you can't see the foundation, let's say. And you could buy that house and boom, next thing you know, you've got a $20,000 repair bill just to fix the foundation that you couldn't see. You can't go up there and look at the roof and all these things. So you're taking a huge amount of risk by just saying, okay, your house market rate is $100,000. I'll give you $80,000 today, right on the spot. You have to be compensated for that. And it goes back to our Open Door video the other day or yesterday. If Open Door is giving them 100 cents on the dollar, over the long run, they will lose money because there's no way that you can factor in those rehab costs unless you aren't paying retail. You're not paying market value. So what are the homeowners' options? Okay, well, they could, if they take this away, or make it illegal for these wholesalers to harass, or in other words, to make it illegal for wholesalers to provide liquidity to homeowners, what's going to happen? More of these houses are going to go back to the bank, and these homeowners are going to lose everything. And or they're going to just go into a black market type of thing where they're doing something under the table to family members where they're getting an even worse deal than they would have got with a professional investor that can really maximize the value and increase the total value by doing a nice remodel or a nice rehab. It goes back to Thomas Sowell's books when he always talks about check cashing. And not in all of his books, but in some of his books, he's talked about check cashing because they get a bad rap and a bad name because the interest rates are exorbitant to most people. But that's because they're calculating the risk. And you have to understand what are this poor person that lives in a bad neighborhood, what are their other options? Right? They don't have any other options. So that's not the fault of the check cashing place. For whatever reason, they're in a bad situation, and that check cashing place is providing a service to them. And even though they're charging high rates, they have to charge those just to eke out a thin margin because they have so many defaults. It's not like they're just making 5,000% on every single loan. No, it's not the way it works. And it's the exact same thing here. You have to get the property for, let's call it 80 cents, 75 cents on the dollar, because just like the check cashing place, you have so many of these deals that blow up in your face because you can't see the jacked up roof or the cracked foundation. See, so in the end, the do-gooders, just like Milton Friedman always says, they always end up hurting the people that they're trying to help.